Hello,
Hello.
am I audible?
Uh, who's that?
Yogesh.
Hi,
Yeah,
Yogesh.
Yogesh, you're
Yeah,
audible.
we can hear you. Okay. Warm welcome to
Good morning,
everyone.
everyone.
Yeah, a warm welcome to everyone. We are having another session of the web series what we are having currently, and it's been last 2 months wherein Manoj Alim Chandani who has taken this initiative, and we are having we have prominent speaker coming up from industry profession, and they are sharing their knowledge and experiences, and we are it's really, we are really thankful that you are joining on this weekend and gaining some knowledge from it. So in the interest of time, I hand it over to Yogesh, who wants to speak about something, and then about the session, and then we can just proceed. Yeah, Yogesh, I hand it over
Yeah,
to
good
you.
morning to all. First of all, thanks to all of you so that you have taken up your time from busy schedule, that too on weekend, and you're there. So I express my gratitude towards that. Coming back to the subject, which we'll be discussing today, is on financial reporting. The COVID has impacted all the corporates, be it industry, be it financial services, be it manufacturing, in one or the other way, and the impact is huge. The impact is actually still unfolding, and the impact is not only limited to financials but the lives of the people who are working for those corporates. So beyond that, if I can try to compute it, or try to kind of conceptualize it in some or the other way, I can say that this is still unfolding and we are still not completely aware about the outcome, how it will actually unfold over the years, and probably it may take few years to understand actually how it has impacted. But if we try to boil down this impact on the balance sheets or financial reportings of the companies, so certainly there is huge impact, be it in terms of impairment of asset, be it in terms of events after balance sheet. Although many of the corporates were were aware about the pandemic as on 31st March, but still many events have happened after balance sheet dates. Many plants have shut completely after balance sheet date. Many lease agreements have been kind of revoked after balance sheet dates. So all these have definitely have huge impact on the financials, deferred tax asset, kind of more kind of probability of income, future income, or certainty of income, what we call, or provisioning, or impairment of asset, or if we see financial instrument, it will definitely have impact on the future cash flows and expected credit losses on those instruments. So even I am keen to know all these things, how it will unfold, what will be the impact in terms of financial reporting. So I hand over the session to speaker so that he can also try to put across his views on all those things.
Yeah, thanks, Yogesh. That was really a good insight about the current environment and what we are looking forward to have in couple of years. That what is the actual impact of COVID? Um, in the do we have Rajesh?
Yeah,
Uh,
yeah, I'm
yeah,
good.
hi,
Hi.
Rajesh.
I think
Rajesh
Rajesh is
is
there.
Yeah, Rajesh, I hand it over to you to give us an insight. I know you are well knowledgeable in this industry, so I'll not take much of your time and hand it over to you. You can
Yeah,
share your screen, and maybe if you can switch on your video, that will be helpful to connect with you. Yeah,
yeah.
thanks so
Thank you.
much.
Thanks. Uh,
Rajesh Bhai, I would just like to share a few words about Rajesh Bhai. Rajesh Bhai is a veteran in the area of financial reporting,
hold.
deep dive, Ind AS, IFRS, 30 years of experience in the subject of financial reporting. And also, I would like to acknowledge both Rajesh Bhai, Santosh Manali, Chheda, who have worked on this area of financial reporting. Rajesh Bhai has been a contributor of articles on financial reporting, internal controls, internal audit in reputed journals, and also a speaker, very enthusiastic on the subject, and often guides lots of youngsters in the area of financial reporting. He has been speaker at various forums of a professional body, and Santosh Malar, author of multiple books on financial reporting. In fact, a couple of books written in this challenging period of COVID also. Experience on as a part of the technical team on practically every subject of financial reporting. Manali Cheda, uh, good experience with Larsen and Toubro for a long number of years. Now part of a big four financial advisory team and doing a lot of value added work on financial reporting, conversion of accounts, Ind AS, different models. We have Sandeep but also as a co-panelist later would share his studies on wealth management. Yes, Rajesh bhai, over to you. Very
Yeah.
good presentation, knowledge sharing, interactive session.
Yeah, thank you for the kind introduction and giving me this opportunity to share my views in this esteemed forum where I think distinguished personalities are there, and it will be. I would be actually eager to know their views also, because this is a subject, as Aditya said, it is evolving period. Actually, it's a very difficult period we are passing through, and it is still evolving, so nobody knows. So I think people may have different ideas or the different outlook how one has to look into, because as you know, in Ind AS regime or IFRS regime, normally it is forward looking information which we look at. So it depends on the estimate judgment. So judgment is a call to be taken by the management based on certain external and internal factors that I think we will see. And but yes, based on that, I would actually like that the session should be interactive and people should also share their point of view, how they look into these things. And so what I have done is that, first of all, financial instrument or NBFC sector is one of the badly hit sector because of this COVID. So I thought that let me take up that first. And so I searched for the research material available in the public domain, and I found latest EY publication that they have carried out on NBFC sector. So I thought I will take up that first part, and the later on I have taken up another sector which is also very badly hit because of COVID, and that is real estate sector. So I thought let me go through one of the financials available in the public domain, a listed entity I have picked up. And I thought let me go through the financials of 2020, how it has impacted, what are the areas, how they have disclosed the things. So I think overall, if we compare both the things together, then I think we will gain lots of insights where we are heading and how these two sectors are coping with the pandemic, and what are the future outlook for this sector, and how government or RBI for that aspect is trying to help this sector to come out. And I think it's a collective effort which is required from the industry, from the government body, from the public at large, the society at large, to come together and see to it that we all face this situation together and come out triumph at the end of the day. I think that's what the base or foundation of this. And let us now begin with the first part, that is ECL model for NBFCs, and how that research material will throw some insights that will be interesting to know for all of us. So let's begin with that. So the background is that in June 2020, EY had published one analysis of Ind AS impact of phase 1 NBFCs. Okay. And based on published standalone financials. So this is all available in the public domain for the year ended March 19. So first they had taken up last year, when that was the first year when NBFCs were transitioned to Ind AS regime. And that time the focus area was the impact areas because of the transition where it is going to hit. And one of the main area which had came up was ECL, because that is how it was going to be drastically changed. Because previously what they were used to do is that RBI suggested certain standardized rule based provisioning, and that is how it was followed. But post Ind AS or IFRS regime, people have to go by a forward outlook, and that's why that provisioning has to go up because of that. And that's why that was the one of the biggest impact area when they transitioned in 2019, right? So that time they had done this analysis. Now again, what they have done is that picked up a few of the big companies in NBFCs and in HFC, housing finance company sector, and they have researched based on the 2020 financials which the companies have reported, and they have carried out the analysis, and now they have tried to compare that what they had done in 2019 and how the things have changed in 2020 balance sheets. And again, because world over pandemic had arrived early, maybe in December. In India, it started in the late, maybe February end or March beginning. But because of that, there were few major impact areas on the NBFC balance sheets when they finalized for March 2020. So that is how they have tried to again analyze what are the impact and what is the comparability between 19 and 20 balance sheets, and focus was on the ECL provisioning, and what are the insights which the management has taken while coming up with the judgment or estimates of forward looking information while making this provision, and how RBI has also helped into this. What are the circulars which RBI came up for provisioning requirements, and based on that we will try to analyze that whether whatever the management has taken care while estimating or making the judgments based on the forward looking information, whether they were right in doing so, or there could be other areas, or maybe whether we should look at only the short term view of the impact while creating the provision, or we should consider medium term or a long term focus, because maybe because now that vaccine is already, I think, in the very advanced stage, and if hopefully everything comes under control by March, then maybe after another 6 months we may have a better outlook for the economy also world over. So that's what my point is, that while making the provision, should the management be looking only at short-term view, that okay, next 12 months how the impact is going to happen, and based on that they should form their forward forecasting, or they should be have a different scenario based forecasting where they can say, okay, in short term I will take up this much as a discounting factor, or this much may be my impact, but in the long term my outlook will be positive, and in the short term, medium term, my outlook will. So they can have a scenario 1, scenario 2, scenario 3, and they can give weights, and based on that whether that is the better way to do this. That is what one of the major points of discussion should be. And I think there is nothing wrong, because we can't say that this is going to remain forever, right? So these are my insights into how we should be looking at, but I will be happy to get the feedback or inputs from other panelists also, and maybe from the participants. So this is how the background is, and let us now take up what the research material has thrown up. Okay. So what they have done is they have compared, they have taken up 42 NBFCs, and focus was on change in ECL allowance and expenses, change in provision coverage ratio compared to last year. The magnitude of impact of COVID-19 they have tried to find out separately, how the impact has been assessed by the management, understanding underlying ECL drivers, and as I said, the last one, approaches on staging, scenarios, models, and overlays. So that is how, because ultimately these are all judgmental call estimates, right? And future forward looking. Now, for the people who are actually not from this field, that impairment requirements for amortized assets, we call it as amortized assets under Ind AS 109. So there we have this ECL model, expected credit loss, and the guiding principles being I have narrated here. But what we do is that it applies to my loans, debentures, which I have actually lended, correct? Trade receivables, contract assets, lease receivables, commitments, financial guarantee contracts, all those things which actually generally are not measured at FVTPL but at amortized cost. For that, we go for ECL model under Ind AS 109. And here, what they try to do is that you have to determine the pattern, whether that my assets standing in my books are impaired or not. And for that, we have to look at the forward looking information about that borrower, his credit standing, collaterals which is available with us, I think, and the industry in which that person is functioning, the overall economy. I think these are the things which we have to take into consideration, and based on that, one has to find out how much provision I need to do. See, if you see, look at 2008 when the crisis happened world over, like before that it was like once that event has happened, then that credit impairment was happening, and because of that sometimes it was too late and a sudden hit was coming and the company was actually nowhere. And based on that, they came up with this new model which was forward looking. And now we have this model that don't wait for the event to happen. You can day one when you are actually lending, at that time you need to assess whether for next 12 months whether there will be some impact or credit deterioration will happen, or maybe your lifetime, maybe I have lended for 5 years. So you have to consider that next 5 years till the time that loan gets matured, what are the chances of that person, the borrower, or the industry in which he is there. All those information have to take care and see that how much is a chance that that particular loan may not be repaid fully, or maybe there is some risk of credit worthiness or something. And based on that, on day one, I need to provide in my books the provision for under ECL model. I think this is the major shift if you compare to pre-2008 model and now based on ECL which we are doing now. So I think this is better actually. You are prepared for the uncertainty of your loss happening in future. So this is how it is done now.
So, sir, is it only applicable to NBFC or it's for the bank also, or it's in general IFRS 9?
No. See, bank actually they have postponed. RBI has not come up, so it is not applicable to banks. But for banks, it is mandatory to follow the provisioning norms as per the RBI, right?
Okay. Yeah.
But they are not covered under Ind AS at present.
So just to add to his opinion, previously RBI had issued one circular and Ind AS was about to applicable last year, but it has been deferred for 1 year initially, and then it has been deferred till the next communication. So it is as good as sine die, or what I can say, till RBI again comes back on it.
So it is like
as of it is deferred.
Yeah, indefinite period they have deferred Ind AS application for banks. But for NBFCs, yes, it is applicable. And for them, so RBI again, I will cover up that. RBI has taken up one circular that you have to provide whichever is actually so lower in the books and extra provision. So suppose in ECL, if I provide as per ECL, that comes to 100 rupees. And if you go by the RBI circular, if it is 110, then how you will do? You need to create a separate reserve. So that is what the circular is saying. I will be covering that also, right? So this is how. So ultimately, the RBI is trying to see that at least minimum level of provisioning has to be there. You cannot say that at the whims and fancy of the management, this is what I want to do, right? So RBI is very conservative, and they want to try to protect this NBFC sector. Okay, so we will see to it. Okay, so if you see, they have in key highlights of this, what they have compared and tried to figure out that overall provisioning coverage rate has increased by 26%. So if last year, whatever I had provided compared to my gross loans, right, ACL provision, how much was there? So there is an increase of 26% compared to last year. And they have again, we will go further. There they have said that out of this, how much is the impact due to COVID-19? that provision has increased, right? ECL allowance increased by 33% compared to last year. And now they have also said that, okay, stage 1, stage 2 taken together, how much is the ECS allowance which has gone up? So it has gone up by 56% if you take stage 1 and stage 2 together, okay? Then ECL allowance for stage 3, like it is like as a thumb rule, if it is 90 days post due, right? So they say it is a credit impaired, like NPA asset ho gaya mera. So there actually more than 25% increase compared to last year. So I think these are all insights which are getting from this research material based on that 40 odd companies which they have taken care. ECL expenses, now see this, increased by 219%. So maybe because of write-offs which has happened. So ECL expenses gone up tremendously. Cost risk ratio is increased by 202%, right? So I think this is what on summarized basis, we come to know that compared to last year in NBFC sector, because it is hit heavily by this COVID, the impact is very, very pervasive, and you will see across NBFCs and HFCs, this is felt. So coming to my next side is what they have taken here. Actually, if you see, they have covered actually NBFCs from 33% out of that 42 NBFCs which they have covered are from HFC sector, housing finance companies. Consumer, MSME and auto sector constitutes of 22% of that 42 companies. Thematic are 12%, microfinance is 7%, gold loan companies they have covered is 5%, and others are actually diversified across sectors. So this is how this is the basis of the means they have tried to cover all the sectors where the impact is going to be there. So this is what they have done. Going to my next slide. Now let us analyze what are the insights they have got out of this research. Overall change in gross loans, ECL allowance and ECL expenses. Loans have grown up by, gross loans have grown up from 13.35 crores to 14.37 crores. So there is an increase in gross loans. And then if we compare stage wise, then if you see everywhere there is a increase. So that is where actually, so if suppose in last year in stage 1 there were 11.91 crore, 11,91,000 crore, then to at 2020 it is 12.73, right? Stage 2 62 se 79 tak gaya, and stage 3 actually 81 to 85. So maybe because of the stressed asset we can say that there is a increase in gross loans. We have to compare the stage where it is there. So based on that we will know that whether it is stressed or not. Correct? Now comparison of ECL allowance, if you see between 18-19, so here again you will find that average overall increase in ECL allowance is by 10.61. So all stages taken together, if you compare, there is an increase of 10%. But average increase in ECL allowance of NBS in first stage is 43%. Stage 2 is 16%, and stage 3 accounts for 3.44. So you can see here that how the assets have moved from one stage to another stage and what is the increase, right? So that's how we can, from here also we can get the insight that because of maybe the stress on this sector itself, how things are moving and how they are going to take care about it. Yeah. So again, ECL expense. So ECL expense actually
Rajesh, I think you have gone mute.
Rajesh sir, unmute yourself.
okay. Audible?
Yeah.
Okay.
Yeah, sir.
Sure. Fine. So Now here in ACL expenses, you will find that the total impact has not yet arrived, because as seen in the note below, it is mentioned that for accounts where moratorium has been or granted, it appears that many companies have frozen DPD status, right? Which has not triggered a stage 2 or stage 3 transfer. Consequently, it appears that an additional ECL allowance has been recognized by way of management overlay to mitigate the future impact on ECL due to expected deterioration of the portfolio once the moratorium is over. So what many companies have done, that they have also taken care that, okay, now because of that moratorium, certain loans they have to freeze. So that has not come into stage 2 or stage 3. But post that moratorium is over, maybe because of the stress in that particular sector where the borrower is there will be certain defaults. So that taking care of that, they have already front loaded that provision into the books, taking a forward looking information. So that's why you will find there will be it is showing more increase of in ECL expenses, because they have also front loaded the future expected loss because of when the moratorium gets over. So this is how people have done. Now, same way this is for HFC. So in HFC also, if you see, there is a minor increase of 2.44% in gross loans. Stage wise also, if you see, there is a increase like in stage 2, previously it was 38 here. So I think from this we can have that insight that during the year, because of the stress in the housing, particularly housing finance sector, right, stage 2 and stage 3 has actually tremendously increased compared to previous year. So if you compare between NBFC in general terms and specifically if you compare HFC, the impact is actually more. This is how we can analyze from this particular slide, right? So here also, if you see, on an average, overall increase in ECL allowance is 116% compared to last year. And from stage 1, it is 123%, stage 2, 112%, and stage 3 is 116%. So you can feel that housing finance sector is one of the badly hit sector because of even before COVID also, because of overall economic slowdown, demand for housing sector has gone down, right? So वो पहले से impact तो था ही, and that impact was grossly increased because of the COVID. So दोनों मिला के, this is the, I think, worst sector which has been hit by the COVID. So ECL expense compare now. Previously we have seen overall, if you compare, it was 164% ECL expense, right? But if you take HFC, here you will find that increase has been 336% compared to last year, right? So we can conclude that out of the overall NBFC sector, HFC, housing finance companies are the worst hit sector over a whole period, not only because of COVID, but throughout the year 2019-20. Okay, and I think now this is again, they are trying to see that out of 28 NBFCs, 20 have shown increase in provision coverage rate, 8 may have shown decrease, and they have also analyzed why it is so. So because the decline is because of the, I think, infrastructure sector, they are saying. More specifically, the increase in the provisioning coverage rate has been witnessed primarily in consumer, MSME, auto finance and microfinance companies, whereas the decrease has been witnessed primarily in the case of infrastructure finance companies. Okay. HFC, 13 companies have shown actually increase, and only one company is there with they are showing a decrease. And if you compare this, out of 13 HFCs which they have taken, where an increase when witnessed, 3 of them reported the increase of more than 300%. So 3 of the HFCs have actually shown 300% increase. So that much extra provision they have done during this period compared to the last year. So again, we can get that insight how badly HFC sector has been hit by COVID or overall sluggishness in the economy over the last 1 year. Again, they are trying to cover how much is the coverage rate from stage 1 and stage 2 asset. So there is a slight increase compared to last year on NBFCs, and HFC also you will find there is a increase from stage 1, stage 2 taken together. So actually see, we always look at the financials, right? But the way it can be analyzed, I think this is how this research material actually throws light that in how many different angles you can analyze the same kind of information available in the public domain. So they have very categorically said they don't have inside information of the companies. What they have done, they have selected the companies, and based on that only, whatever is available in the public domain, they have done this, carried out this research. Okay. And in some of the companies where they have mentioned that information was not available, they have said we exclude these companies because information was not available. So whatever information was available, they have done this research. So I think this is one of the way we can also try and inculcate how in different ways we can actually read the balance sheets and financial reports and get the insights or forward-looking information where the economy, where the company is heading, or where the sector is going to head in the next term. I think this is one of the key takeaways out of this session. See, I was talking about that impairment reserve, as I said. So the Reserve Bank of India issued a notification on 13th March, friends, stating that NBFCs should simultaneously maintain asset classification and compute provisions as per extant prudential norms on that income recognition, asset classification, provisioning, right? Including borrower or beneficiary wise classification. Now, in case where impairment allowance under Ind AS 109 is lower, correct, then the provisions required as per the RBI norms, then they are saying that you need to create a reserve. So because Ind AS is very clear, friends, that you have to actually calculate as per ECL provision, and whatever ECL provision comes, that is what you can take it in your books. You cannot actually provide excess or lower than that, right? So wherever RBI said that as per ECL you are getting whatever amount, but as per my norms, if you are required to provide more, then you will create a separate reserve. We call it as an impairment reserve, correct? And that the balance in the impairment reserve shall not be reckoned, correct, for regulatory capital. So you cannot include that reserve as a part of your capital. Further, no withdrawal shall be permitted from this reserve. So they are very clear that this is actually earmarked reserve only for the purpose of impairment. You cannot touch this reserve. So directly or indirectly, RBI is saying that yes, we should be very conservative while making the provision. Maybe because of Ind AS 109, you may be getting some lower amount. But if my provision says that you have to provide more, please create a separate reserve, and you cannot touch that reserve, right? So that is how they are trying to be conservative, and that is why even in 2008, friends, you will see that overall all over the world banking sector was worstly hit, but we survived that because of the RBI's conservative approaches. Now what the macroeconomic factors the standard is saying, as well as now we will say what the management has included while actually deriving those or while calculating their ECL provisions for March 2020. So as per 109, if you see, friends, standard is very clear that they want that the information should be forward looking and it should be unbiased and probability weighted amount that is determined by evaluating a range of possible outcomes. So that is what I was referring to. We cannot go by only one single outlook, right? We have to have a possible scenarios, and based on that we apply the weights, and then we come at a figure which we feel that this is the right figure. Okay, the time value of money has to be considered, and third one is most important, friends, reasonable and supportable information that is available without undue cost or effort at the reporting date about past events, current conditions, and forecast of future economic conditions. So we have to take both past, present as well as future, and based on that then we arrive at our ECL provisioning, right?
Good morning, sir.
Yeah.
Sir, impairment reserve is due to COVID, or it is as per Ind AS because of the regular practice of HFCs?
Actually, see, actually it is coinciding with March 2000 COVID also, but basically RBI came up with for NBFC overall.
As per Ind AS accounting, but it has no relation with the COVID.
Yeah, indirectly no. But my point was that here that RBI is trying to be conservative, correct? But as per Ind AS, please unmute mute yourself. There is a disturbance which is coming. Yeah. So what RBI is trying to say, that is what the my says, that whether it is due to COVID or without COVID, Ind AS is very clear. When you make the provision, you have to go by as the macroeconomic factors which they have outlined. So right. So based on that, whatever figure you get, if it is below what the RBI is saying, then in the books you will go by Ind AS, but a separate provisioning has to be made as a impairment reserve. So RBI is trying to be more conservative actually, friends. Correct? So that is what I am trying to say.
Yeah. So Rajesh sir, Santosh here, if I may add.
Yeah, please.
Basically, this notification, it attempted to kind of address the confusion that was prevalent amongst the NBFCs, as Rajesh sir rightly pointed out.
Correct.
This is mainly, see, this scenario will arise in case of very few NBFCs that, where ECL is actually less than the impairment or provision that is required under RBI guidelines. Mainly it will be CICs. In my experience, it will be mainly core investment companies who are, for the purpose of Ind AS, they are counted as NBFCs, but they may not necessarily undertake much of a external lending activity.
Correct.
Like, for example, Birla Group or Tata Group, they would have CICs within those groups.
Correct.
So this circular, what it is saying is, so there was a confusion last, the first balance sheet when under Ind AS, there was a confusion that what prevails, ECL will prevail or RBI guidelines will prevail, because RBI guidelines have not been withdrawn, because they also apply to banks.
Correct.
So therefore, see, if I go by earlier the confusion was like this, that if I go by the RBI guidelines, then I'm not, in the framework of my audit report that I'm saying that I'm asserting a compliance with Ind AS, then that goes wrong.
Correct.
And if I go by ECL, then RBI guidelines, which is, the rule of the law, is not followed. So what happens? There was a conundrum. So this notification actually addresses that confusion, that as Rajesh sir rightly said, that you make provision of higher of the two on a more conservative basis. But because you are also bound to follow ECL, and as an auditor, I am bound to, assert the framework as per Ind AS, I will only make a impairment reserve. So this is not essentially a hit in the P&L. This is a reserve. So I have that cushion, extra cushion, as per the RBI guidelines.
Perfect. Right. Thank you, Santosh. So hope it clarifies the doubt, right?
Hello, sir.
Santosh, a small question. How do you say that if it is a provision, if it is a reserve being created, even then it would hit your P&L? How is that it won't hit your P&L? Because whether it's ECL or impairment, ultimately the impact will reflect on P&L in one way or the other.
Yeah, so Pramodji, see, now this notification, it does not spell out clearly whether the reserve should be created by, by way of a hit in the P&L or as a reserve to reserve. So as a kind of an appropriation out of free reserve. And there have been divergent practices even there also. Many CICs took a view that, this is, and the notification does not spell out whether it has to be, created out of a hit in the P&L. So therefore it can be a reserve to reserve adjustment.
Or maybe it may be from the other OCI. It may not be from, through PNL.
Well, yeah,
it may be through OCI.
No, no, OCI. So OCI is not something. So OCI you can hit, or you can, recognize a gain or loss in OCI only if any specific standard permits that. So OCI तो हो नहीं सकता sir, but within the reserve हो सकता है, because it's not very clear. This is a reserve which I'm creating under the RBI notification dated 13 March 2020. It doesn't spell out whether I take a hit in the P&L or I do it as an appropriation. So it can be, many companies have actually taken a view that this can be done by appropriation also.
Correct. And yeah, and coming to see the comparison, out of total 28 NBFCs, only 2 NBFCs have created reserve, maybe because as Santosh said, only few of the companies may have taken this. So this is one of the example which can prove again. And if you see HFCs, not a single HFC has created impaired reserve. The reason being that for HFCs, the circular came late in October 2020. So maybe they were not knowing, or because that was under NHB, right, Santosh? So maybe because of that, they could not do it.
And also, sir, I feel in HFC case, especially in today's scenario, and as you also mentioned earlier, right, slides, that in HFC's case, most likely ECL will be higher because of the management overlay also.
Right. Because that is the worst hit sector actually.
Correct.
So is it a compulsory? Sorry, sir. Is it a compulsory that NBFCs should show the impairment reserve in their annual report?
No. See, you have to first calculate as per ECL, no? So whichever is higher. So suppose my ECL is actually lower, correct? So as per Ind AS, I will go as per ECL model. I cannot provide higher, right? Otherwise, I am not following Ind AS regime. So that's why RBI said, okay, for that you create a separate reserve. So that will be reflected, no, in your SOCI also. It will get reflected that this is the impairment reserve you have created. So it has to be disclosed in a way.
Okay, and what is the procedure to write off if I want to write off in future?
No, it is not write off. See, reserve is actually I'm creating some cushion, right? As Santosh said. So in future, suppose actual rate goes up, then already you have taken care of that by providing a separate reserve. So then at that time you can transfer that from impairment reserve to your normal reserve again. Free reserve.
Okay.
This is how it will have, because it will not be routed to P&L because you have not created out of P&L, right?
So
but,
yeah. So,
correct.
Carry on.
No. So that's how it will be. So जहाँ से निकाला था वापस उसको आप free reserve में ले सकते हो once you get the actual hit in your P&L account. This is how actually I should read.
Yeah, just to kind of clear the air, I think there is some confusion. So see, in case of ECL impairment, I still make the provision through my P&L as normal. There is no confusion on that.
Correct.
What this notification says that because NBFCs now are subjected to two frameworks. One is the Ind AS framework, ECL framework, and the other is the RBI IRA CP guidelines, which has its own independent way of prudential norms, gives a different framework for provisioning. So because you have two parallel frameworks, okay, the higher of the two will prevail. So even after you measure the ECL as per Ind AS, you also have to compute parallelly the RBI prudential norms provision.
Correct.
And if that turns out to be higher than ECL, okay, will be it's not a case which you will encounter that scenario very often, but nevertheless, if that is the scenario, then the excess amount is transferred as a reserve, as treated as a reserve.
Correct. Right. Hope it clears.
I think sorry, Ramesh here. I have a question, follow-up question. So when I create a impairment reserve, say through my reserve, through my general reserve or P&L account that is below the line, can I use it subsequently to say set off the write-offs that I'm making? The question is here is, since this reserve is created not through the P&L, then I think it will not be fair also to set off the write-offs.
Correct.
So what is your thought on that?
Santosh also can add, but what I feel is that because it was not created out of P&L, your hit will go to P&L actually, and the reserve should get transferred from your impairment reserve to your free reserves. Actually, this is my view.
Okay, yeah, I think that also I kind of tend to agree.
See, next year, just to add, next year what will happen? Again, you will make the comparison of the two.
Yes.
And then let's say there can be a scenario that if ECL is higher and your RBI prudential reserve is lower, okay, then you will reverse this reserve.
Correct.
You will, reverse this, utilize this reserve.
Okay. That will be kind of independent, you're saying?
I'm sorry?
That will be kind of independent, while write-offs may again be debited to...
No. See, answer remains same. Whatever scenario, what Santosh is trying to say, that either of the two, whether it is actual write-off which has happened or maybe ECL provision has gone up, because that hit will go in your P&L actually, right? So he's trying to say that you will try to match whatever excess was created last year in the reserve will actually should get transferred to your normal reserve. Ultimately, that net impact only will be there. Got it?
Okay.
I would like to add, Mr. M. Ramesh has a lot of domain expertise in the areas of financial sector. He has experience in the areas of financial rating, financial sector ratings of the #1 rating agency in India for a very, very long time, and a regular contributor on panel and think tank forums.
Great.
Pleasure meeting.
Pleasure.
Thank you.
Thank you for your insights.
Rajesh, just a small question, a very fundamental and basic question. Will it really be principally correct, when you want to create a reserve in principle has to come from the profit. If you are creating a reserve from an existing reserve, are you really creating a reserve? And plus, that is the situation you are assuming that there are past reserves. What in case if a company does not have the past reserves? In that case, what this company should do? Should it take the hit to the P&L, or how it should be?
Actually, a very good question. I think there what will happen, that's a call which the auditor will have to take. Santosh, if you can add, because because if there are no reserves and still as per ECL provision, you are getting some lower amount, right? And RBI says you have to create more. Then suppose in that case, I have no other choice but take it from my P&L account. So to that extent, maybe auditor will have to take a call, judgmental call, that anything above ECL model, if it is provided, then as I said, it's a call to be taken by the auditor. But you have to, because ultimately both are actually under statute. But RBI law will prevail actually. So you can't say that I will not follow RBI, I will go by Ind AS, right? So RBI you will have to follow, and maybe because of that you may have to take your hit in the P&L. That is one way. Or maybe Santosh, I can directly take it my not OCI but debit into my general reserve, even though it is a negative figure, and then because of current year's profit, overall net figure may be positive.
Because if I can add further, Rajesh ji,
please.
Because if loss is likely to happen, provisioning has to be done, and RBI is absolutely right in their approach when they say that the provisioning has to be done as per the guidelines of Reserve Bank of India, because they are more prudent actually, and they would always insist on the prudence actually.
Correct.
Now in OCI is an area which is primarily for the purpose of taking the debits and the credit in your income or the gains, which are coming as a result of something which is not frozen but likely to happen actually. And therefore, instead of setting it of against an existing reserve, it would be much more appropriate to take it to OCI, because subsequently, in case if it reverses in future, then this loss this can be reversed in the future through the OCI itself. Actually, that I think would be more. I mean, it's my view. Would be more appropriate to do, rather than to do reserve to reserve adjustment, because in principle, if you see, a reserve is created out of profit. So if you are transferring from one reserve to the another reserve, where are you creating reserve? You are only doing accounting jugglery, which principally may not be correct.
No. See what RBI said. Yes, I agree with your take, but RBI said that whatever this impairment reserve we are creating, I will not allow you to touch that reserve for any other purpose. Right. So there is a restriction, right? So it is a earmark reserve I am creating. It is not a free reserve. So indirectly I am setting it separately, which is untouchable. Okay. So that what your doubts are there, it is taken care of. Even if I go through OCI, yeah, that may be one of the right way. But as Santosh has said that what OCI they are saying that it should be like from specified from certain standards. So here there is no standard which is specifying that it should be routed through OCI, correct? So so he said that there is a diverse practice. One can follow this also and that also. But standard is silent here. Okay. So, but taking your point of view, even though if I transfer from one reserve to another reserve, has that reserve, I have a right to transfer, use it as a my whims and fancy? No, because RBI is again saying that you can't touch that reserve.
Sir, Mayur here, I have one point over here. Sorry. I have just one point over here. So in the slide which you are presenting right now, it is showing the difference should be appropriated against the net profit only.
Yeah.
You cannot transfer it to reserves. So I believe like the difference between the ECL provisions and IRAC norms, whatever the less, if the ECL provision is less as compared to IRAC norms, then the difference need to be get apportioned from the net profit after tax. So
no,
it is
but
clearly
that's
mentioned
fine.
in the circular also,
Case,
and I think
no, but it doesn't say from the statement of profit and loss.
Yeah, that they are not saying. There is silent.
So there is still not, there is still ambiguity, I would say. But to answer Pramodji's question, sir, see, this is more or less like we also create 45 IC reserve.
Correct.
For NBFCs, as per the law, we are supposed to also create a special reserve under Section 45 1C of RBI Act. So this is a bit similar to that, which I create as an appropriation. See, again, 45 IC, whatever reserve I create, that's not out of profit for the period. It's out of an appropriation. So this is also, one can say that this is also akin to that.
Correct. But see, but point is, sir, ultimately, RBI is very clear that you can't touch from wherever you create the reserve for the timing, suppose we say, but that reserve is not available for as a free reserve. You cannot declare dividend. You cannot use for any other purpose other than for impairment purpose. I think that is what the conclusion is.
So earlier you said, earlier you said that in HFC cases, ECL provision usually higher than the RBI provision. So what gives you confidence? Means what is the what is the reason why you are saying that?
See, because if you see the last full year, there is a sluggishness in the housing finance sector, right? Because the real estate sector, which is the main contributor, buyers ही नहीं है. You see the reports of that real estate report, you will find so much inventory has piled up during the last 1 year. Okay, so not acres. So उसका है तो उसको business कहाँ से मिलेगा? Correct. So because of, and second thing, because of the economy which has gone down, unemployment has gone up. That loans has become stressed loans. तो आपने पहले भी देखा रहेगा कि HFC में stage 2, stage 3 में जो transfer हुए हैं loans, these are much higher than compared to overall NBFC sector. So because of all this, ECL provision is tremendously higher compared to NBFC if you see the HFCs. That is the main reason.
So, but I have another view on this, because in kind of housing loans where the NBFC is given a housing loans category, or I would say HFC has given a housing loans.
Yeah.
So there they have a collateral in the form of house property, and in those cases the property value is far more, because the HFC is also keeping a maybe 20% or 30% as a minimum LTV has been required by the RBI norms or NHB norms or RBI norms. So considering that the LGD ratio, whenever we calculate based on past historical data or maybe even the current historical data, the default, the recovery from this loans are very, very high. And the losses which is actually been incurred in such kind of losses are comparatively very low. So I'm still wondering like why the ratio is increased. And secondly, even when I talk about the probability of default, since the borrower has been provided the moratorium period, so anyway this should not have impacted my probability of default calculations also.
Sir, if you have seen my earlier slide, there they have said that management has taken a view that once that moratorium gets over, there will be a higher provisioning required because that loss will be higher or default will be higher once that provision, that moratorium goes. So that's they have anticipated and front loaded in their provisioning. That's why that provision has increased. And second thing, you are talking about one aspect of housing finance, right? Because there can be lending to real estate sector itself. Construction loans are there where actually WIP has increased, but actually inventory is piled up and nothing is coming out. There are major defaults in the companies, right? If that Peninsula, which I am going to take up next, there you will find they have defaulted in the repayment of loans, term loans also. So one sector you are saying, and second thing, collateral itself has gone down value wise actually. It is not that it is going to appreciate only. In many sectors they have gone down also. So LTV is very, very important ratio. So if you are aggressive and you are providing more actually loans and compared to the your haircut, then possibly that there in those cases the provisioning will be higher. And wherever you are conservative that I will have a haircut of 50%, right? So in that case, you are secured that even after there is a fall in my collateral value, it will take care of my exposure, right? But in many cases, people are aggressive. They have lended up to 90% or something like that also. So in those cases, wherever there are such type of aggressive lending, they have suffered a lot. And because that collateral value itself has come down during the last one year. So that the overall, if you see, you have to consider all the sectors, right? And second thing, जो borrower है उसका every time it is not liquidity भी होना चाहिए ना. Collateral you are having, but you can't sell. Then what will happen? You are not able to recover those things. So that also things has to be taken into care. So based on that overall HFCMA you will find more provisioning. This is my take.
I would like to acknowledge Mr. R. Kannan has joined us also, and he has a very senior level experience. He has been Executive Vice President of ICSI Bank, Head of Financial Performance of the Hinduja Group, and closely associated with industry bodies in various committees, and also has a lot of interest in NBFCs. I would just request all participants, when they are interacting, feel free, but please put your videos on and also mention your name and company name. That will be helpful to everybody. Many participants have got very excellent insights. Yeah, Rajesh bhai.
Yeah, thank you.
Thank you, Mr. Madan. We have more to learn.
Yeah, welcome, sir. Welcome, sir. It's a pleasure. Welcome. So these are the macroeconomic factors. They have analyzed that this is what they have disclosed by way of notes in the final statement, that which are the insights or future outlook which they have considered for macroeconomic factors the companies have considered while actually taking the judgment over the ECL provisioning. So here they have said that GDP and unemployment rate were the most common macroeconomic factors that were considered by the companies while evaluating the impact on their ECL computation. Further, many companies also consider inflation and interest rates. However, it is to be noted that while companies may have analyzed various macroeconomic factors that could have impact on the ECL, it may not be necessary that all the macroeconomic factors would have a direct correlation with the ECL. Yeah, but as I said, it is a forward-looking. So this, generally, these are the macroeconomic factors the companies have actually considered while coming to a judgmental call on how much ECL provision has to be taken. So this insight should help us. Now here they have given breakup that which company out of the total, how many companies have gone given weights, more weights for which factors. So this also should throw much light. Like if you say 5 companies out of NBFCs, they have changed in model through stressing based case scenario, change in weights assigned to scenarios, applying PD applicable to rating, which is a notch below the actual rating. So here actually they have considered these are the factors and they have given more weights on such factors. If that is that stress is more on that particular area, then they have provided more. They have changed the weights also depending on the scenario. So here can be like short term, medium term and long term. So based on that, they have now changed their weights. Kitna pehle, how much it was given, and now because of COVID, how much weight should be given to short term, medium term and long term, right? And if that credit rating agencies have actually downgraded your ratings, then based on that, more provisioning is required for such type of, the probability of default will be higher. So that's how 5 companies has given such weight, right? In 8 companies, management overlay based on factors like early warning indicators, delayed payments, deterioration in macroeconomic factors, actually they have been given more weightage by 8 companies, right? So this will give us actually scenario wise that how the management has actually given more stress on which kind of factors actually, and that should help us. Same way HCFCs, you will see, I think management overlay based on factors like stress in specific sectors, comparison of outstanding exposure with third party collateral valuation report, as you are saying, like, so they have gone for third party valuation, as per their the value is so much, but actually वहाँ पे जाके field पे जाके I will send my valuation people and they will come up with the actual value and maybe whether it is liquidable, which is unliquidable. So those are the factors which the management considers and then accordingly gives weight and how much factoring should be done for such kind of scenario. So actually, but these are all logical and actually one should always go by such kind of things if they have to consider the forward-looking information, right? Now, COVID, another macro factors which they have considered is, I think this is, I think one more slide, and then we will be to last part of my session, that is Peninsula. So impact on ECL allowances that we have actually considered पहले भी देखा है, but here they have compared कि total ECL allowance में because of COVID, how much is the impact. So if you see by that first slide, that part 2, total is my 22,709 suppose crores. Out of that, 4,658 crores has come up because of COVID impact. So this way you can understand how much impact is there because of specifically for COVID reasoning, right? So because of COVID reasoning, they have actually has to provide more for ECL. Yeah, that's impact of moratorium on staging. That's what I was trying to analyze, that अभी तो मालूम नहीं है, लेकिन future में जाके when that moratorium ends, how it is going to impact, that also needs to be considered actually. So uska we will come to know only in future after maybe third quarter or something. So to conclude actually, how we should be ready with the things. See, payment.
Hi, if you're not talking, please keep your mic on mute.
Yeah. So friends, we have to look into the things that once that moratorium happens, then how much the transfer will happen between stage 2 and stage 3, that has to be very closely monitored. I think that is where everybody is worried. क्या होगा जब moratorium चला जाएगा, कितने more defaults will come, how many people will shift from stage 2 to stage 3. I think these are all uncertain periods and we have to wait and pray that things goes properly and we come out of this period and again we bounce back as a country and as an economy, right? Payment behavior of borrower post completion of, again these are all actually because अभी तो मालूम ही नहीं है ना कि underneath क्या हो रहा है. Moratorium में there is, we have actually ignored. but actually how much impact is going to happen, we have to wait and see कि कितने sectors में कितना ज़्यादा stress बढ़ने वाला है. Again, important is government support measure. Today only I think Sitaraman has said that this time ka budget will be actually that is what I have read in the paper. How much we don't know, but it will be one of the best budgets. So let us hope that whatever stimulus is required from the government, support is required, if that come in to, and particularly to the stress sectors, then I think we will be able to cope up, and the stress will be less on our financials. But hope for the best. But this is how the present scenario is there. It is uncertain. It is very scary, and let's hope things goes in a positive manner, friends. Otherwise, for at least 6 to 1 year, we will be still be facing challenges as far as the ECL provisioning concerned, and we have to be very alert. And that's why they are, in conclusion, they have said assessment of credit worthiness of the borrower has to be on a regular basis. You can't say that एक साल में एक बार मैं देखूंगा. Continuously you have to monitor. Mitigation of credit risk कैसे करोगे आप, right? तो उसका valuation of collateral आप करवाओ. Try to see that whether वो bad होने वाला है तो उसका collateral का value क्या है. Regularly back testing in order to reduce the difference between an entity's estimate and actual credit loss experience. The estimates and ECL should be back tested and recalibrated. Entities should regularly review their inputs, assumptions, methodology, and estimation techniques used for calculation. So it has to be regularly revisited, and depending on the change scenarios, it has to be recalibrated, friends. So I think overall, these are the insights which we can take from the well-researched material done by EY, and I think it should help us in helping our clients, or if we are into that from their side, to take a view how to be in line with the RBI circular, as well as how we can go ahead with the provisioning norms. So that was first part of my presentation, friends. मनोज जी कितना 15 मिनट और?
Sure.
Okay, so now what I have done is that I have taken about the company that is Peninsula Land Limited, right? So real estate sector, and extracts from the financials which they have published for 2020, and wherever I found that some interesting notes are there, some interesting accounting which they have done, impairment is there, right? So I have focused on those areas and tried to assimilate and collect this information, so we can get some insights out of this real estate sector also, right? So based on that, let's start, friend. First I have taken up the auditor's report. There actually, if you see, there material uncertainty related to going concern. So here actually, yes, because it has also come in the paper also that they had defaulted in payment of their obligations, right? So paper mein bhi aaya tha. So based on that, auditors have said that because of that default which has happened, and there is a likelihood that because of the liquidity crisis which the company is going through, if they are not able to arrange for the funds, or they are trying to monetize the non-core assets also. I think that is what we will see from the balance sheet also, we will find. So if those things fail, then there is a high chance that the company may be not a going concern. So there is a material uncertainty which the auditor has tried to draw, right? Second thing, again, they have said the EOM paragraph that because of COVID situation, again, real estate sector is a badly hit sector. So because of that also, if situation does not improve, then impact will be adverse on the company. So this is how in the two, one is that material uncertainty under 570 they have reported, and under emphasis of matter paragraph they have tried to draw attention that maybe because of COVID, how the company is going to get badly impacted. And if you look at key audit matters, friend, here again this is very interesting, assessing the carrying value of inventory. That is what they have said that this is my key audit matter. Why? Because here again, because of the stress in the real estate sector, maybe my NRV has gone down. compared to my cost. So maybe possibility that I will not be able to recover my cost also to certain type of inventories which is lying in my balance sheet. So there actually to judge what is my NRV, that becomes a very, very judgmental area, and that's why auditors have said that carrying value or comparison with NRV is the area which is a key audit matter, right? And what they have done is that they have said what methods they have used to come up to a conclusion that whatever management is saying that this is my NRV, whether it is reliable or not, and what procedures the auditor has carried out to cross check. So this is again important, so that I thought that this is an interesting thing, we should be looking at it, right? Again, impairment of investments and receivables from the investee. Mostly it is like subsidiary companies. So this entity, if you see, there are more than 31 subsidiaries and another 3, 4, 5 associate and joint ventures. So if this company has actually lended interest-free loans to them. So because of that also, and plus investment in subsidiaries, and all those subsidiaries are also into real estate sector. So because of that, they have carried out huge impairment hit in the balance sheet. And so that become again an area of key audit matter for the auditor, and that's why they have covered it here, that how the company has assessed the impairment testing of those investments and lending which they have given to the subsidiaries. Now coming to Caro, friends, here what is interesting is that that clause 7A, undisputed statutory dues including PF, ESIC, tax, everything have not been regularly deposited with the appropriate authorities, and there have been serious delays in large number of cases. So here again, it again throws light that how much stress the real estate sector is going through. Major problem is the liquidity crisis, friends, because there is a mismatch between the fund flow and the inventories are piled up, right? And if you see the table, you will find that small amount of TDS the company is not able to pay, like 44,000, 27,000. These are small amounts, right? And since how much it is pending? June 2019. So that's how bad the situation is, friend. That's why I thought that let me take up this as a slide. And there are disputes, that is fine. But see the amount of dispute, total amounting to some 111 crores, right? And main important part is they have defaulted in the repayment of loan. So in the State Bank of India, if you feel paid subsequently on 23rd April, but as on the reporting date, there was a default. For one loan, they have to go on for moratorium period, correct? And overall default, they are saying that it is 17.3 crores. So that's why this becomes important. Now here, significant accounting policies, I wanted to cover this operating cycle definition, friends. So generally what we feel that as a thumb rule, it is 12 months, right? But here in the case of real estate, how they have defined, see, it is very interesting. The operating cycle is the time between the acquisition of assets for processing, their realization in cash and cash equivalent. The normal operating cycle in respect of a real estate project under development depends on various factors like signing of sale agreements, size of the project, phasing of the project, type of development, project specific complexities, technical and engineering factors, all those, etc., etc. Statutory approvals needed, and the realization of project receivables into cash and cash. So this is a cycle, right? So based on these factors, the normal operating cycle is generally in the range of 3 to 7 years. Accordingly, project-related assets and liabilities are classified as current and non-current based on operating cycle of the respective projects. So maybe some projects may have 3 years period. So there it will be operating cycle will be 3 years. Some other project is actually long term. So there it can be 7 years also. So this is how the company is defining. And for all other assets and liabilities are classified as current based on the operating cycle of 12 months. So other than this project-related assets, all others will be like my normal assets, which will be under 12 months. So this is how the company has defined. So I thought it is interesting to bring to your notice. Now this is again that estimations, right? So in the estimation, again NRV, because that they also covered under key audit matter. So again NRV is the main point as far as the real estate sector, because it is not that much easy to determine what is my NRV of that inventory. Yeah, accounting policies of inventory, what goes into my inventory, what are my direct costs, what are indirect costs, that they have defined in elaborately they have defined. Now, if you see B, that is here, inventory other than raw material above are valued at lower of cost and net result value. Raw materials are valued on a weighted average cost basis. Santosh, if you are here, I would like to know, actually at the end they are writing again that whichever is lower, but here in the accounting policy they are saying that they are actually valuing raw materials on that basis. So whether it will be in line with the standard?
Well, actually, you're right, sir. I believe this is not correct, because I think if you recollect, even under AS, there was this FRRB common errors.
Correct.
Which had specifically pointed out that, where it comes to raw materials, you cannot, many companies in fact have this policy which states that raw materials are at cost, and you're right, it should be lower of cost and NRV. So you still need to make that efforts of finding out the NRV for raw materials also.
Perfect. So that's why I thought that let me bring out this lacuna, what they are following. And now coming to revenue recognition, interesting, when 115 came, friends, one of the major sector which was impacted because of this transition from AS 18 or Ind AS 18 to 115 was real estate sector, because suddenly one fine morning they found that whatever revenue they were used to recognize on proportionate basis for percentage completion basis, now based on the strict analysis of the interpretation of the clauses which defines, that is specifically para 35. So there suddenly they found that everything will be at the point of time of sale, that is at the time when they give actually possession or something like that. So here also if you see, the company generates revenue from real estate construction contracts. The sale of completed property is generally expected to be the only performance obligation, and the company has determined that it will be satisfied at the point in time when control transfers. So that so whatever, if they were following proportionate completion, suddenly they found that it is not possible. They have to reverse everything, and there was a huge impact on real estate. And now even though they have actually agreements are in place, contracts are going on, construction activities full-fledged going on, but still that revenue cannot come to their books unless I think the possession or the actual transfer happens at the end of the. So what will happen, friends, because of this, many money even I have received, but it will go to my P&L as a revenue only after 2 or 3 years, depending on when I hand over the possession to the. And so this is one of the area where there is a huge impact on real estate sector. Now last here, if you find note number 21, barter transaction and joint operation. So here in this case, because of again 115, we have to gross it up, that whatever transactions has happened between landlord and the builder or a developer, right? So they have entered into that barter transaction. No money will flow. He will hand over the land for development, and against that builder will have to give the possession of some constructed flats or property in some square feet, right? So this is a barter. So at what point in time this should be recorded? So that's why this 115 is very clear that it should be grossed up at the time you enter into the agreement, right? Santosh, if I am you can add something.
No, absolutely, sir. This is a problem for many real estate companies. Joint development agreements, when typically the builder takes a vacant land, or may not be even a vacant land, it can be like a redevelopment project also.
Correct.
Where basically
please put the videos on, please. That will help all the participants.
Sure. So the builder takes the land, and basically the in return of that he has to get some. He has to give the constructed properties or units to the other party.
Right.
In that case, typically earlier under IGAP, many builders used to, follow this accounting of net accounting. Basically, of course, also there are some service tax for now GST implications.
Correct.
So now the 115 is very clear that you need to gross up the two. You have to treat the accounting treatment has to be as though you are basically that fair value of the land which you are getting.
Correct.
Is like a cost of your construction, and therefore it is it's a gross accounting.
Perfect. Right. So actually my liability also will come in my books, and as well as my cost also will go up. So asset also one side, right? So that is my gross accounting. So I think previously this was not being done basically in India, but as he rightly said that there can be implications under my tax laws, GST, service tax, and they used to say that why not I should charge on that agreement value, and please pay tax on that basis. Even income tax also, there are so many litigations going on based on this, that why I should wait for the actual when you hand over the constructed property, why not now only I should tax on the barter transaction which has taken place. And litigation is there, Santosh, you rightly you said, and it's a very litigable area, and no clarity has come from the even government side also. So that's why I thought that this note is very relevant as far as this real estate is concerned. Now, friends, if few slides are there, so I think we can wrap up in next 5-7 minutes. Again, my stress was that if you see all this, my investments in subsidiaries, huge hit has been taken up. Provision for impairment, provision on informants, almost all the, and particularly if you see deemed investment in subsidiaries here. So what is this deemed investment, friends? If you are aware that whenever I give something not at fair value, like in this case majority of my loans which I had given to the subsidiary was at zero interest, right? So Ind AS is very clear that wherever there is zero interest loan you have given, you have to fair value it as on the initial recognition date, means when the transition happened, and whatever difference comes, that will be shown as my investment in subsidiary. Deemed, that's why they are showing it as a deemed investment. And so to that extent, my loan value will come down. And every year, because of that unwinding of that discount, I will show interest income on that loan. That will be like deemed interest. And my loan value will go up simultaneously every year. So that one day when actually that maturity comes, I will receive the actual fund which I have given. So here there is a deemed investment they would created because of that, and that impact you see, friends, it is 211 crores because of that fair valuation of investment. Okay, and that also now it is doubtful. So they have provided fully on those deemed investment also. So almost I think I would say, because all these subsidiaries are also into real estate sector, the whole balance sheet has gone for a toss, and that's why all these defaults, liquidity crisis has come, and that's why this peninsula is facing this problem. So that's why I thought let me highlight all these things. And yeah, even debentures also you will find there are problems, right? Okay. See these loans. Yeah, note number 8. You can see huge provisions, sir, friends. Doubtful debts they have provided on loans. See, out of that total, 272 are credit impaired. So all this, if because they are also into real estate, that's the problem. Yeah. Now, most important point, as they have said in their note, we have seen in our material uncertainty para in the auditor's report that they are trying to monetize their non-core assets. Like, so here if you find they have transferred certain investments in land, building, as well as investment which was there, now they have treated as held for sale. So they are trying to dispose of certain non-core investments and try to monetize those things and repay the debt. So that is what the strategy with the, I think I would not say it is a strategy. They have been forced to adopt that way, because otherwise they will be in a big problem. So you will find that they have sold huge land also and property also in Mumbai, and they are trying to dispose of certain investments in subsidiaries also, so that they can repay the debts. So see, assets held for sale, note number 19, commercial land and building, 286.72 crores. Residential unit in building, 3 crores. So 290 crores already they have tried to dispose of, and mostly in this year they are saying that it will be disposed of, and to that extent that loan will be repaid. So this is what the strategy is there. And if all these things get successful, then the company will survive. Otherwise, it will be difficult for them to survive. And maybe next year we may find there is a adverse or negative report on the company, and it will be difficult for the company to go ahead, even though it's a good company overall. But because of the bad situation, friends, and because of the defaults which has happened, friends, all my loans which is standing as a long-term loan, because I have failed in the covenants, I have defaulted in loan. So as per Ind AS, it is very clear, everything will be treated as my other current liabilities, and I have to treat it as a current liability and not non-current liability. So huge impact on my equity ratios. It will hit badly hit. Right? So here they have disclosed what are the covenants they have failed, what are the defaults they have made. So that's why note number 4, 5, 6 are important, right? Yeah. See now, in this current maturities of long-term debt, 917 crores, friends. So everything has been shifted from long-term to short-term because of this failure on the part of the company to fulfill the obligations. Huge impact, friends. Correct? Now expected credit loss, how they have done, why they are saying that it is not that much critical as far as the receivables, because if you see overall receivable is very low, friends, right? But like it this, let us see this note specifically. The movement in the allowance of impairment in respect of loans and financial guaranteed, see this, huge impact, 171 crores they have additionally provided this year. So total now it is 473 crores. They are saying that there is a allowance required for impairment on financial guarantee and loan commitments. Correct? So that's why I think overall it's a stress balance sheet, friends. And even though company is good, promoters are good, management is good, but because that sector is passing through a very bad phase, so they are also facing this problem. Hope this is short term and the company comes out of this. Because, and now see, because of this 115 impact, contract balance and performance obligations. So even though company has received these funds, 714 crores, they are not able to take it to revenue because of 115, right? So they will have to treat it as a contingent liability. And same way, they are saying that out of this, if they were allowed actually to go by proportionate completion basis, then they would have actually taken to my P&L revenue worth 1086 crores, right? So, but because of 115, they are not able to do this. So from this note, we can find out whether the company is healthy as far as their operations are concerned, or they are not healthy. So this throws light, note number 45.2, friends. That's why I thought, let me take it here. Yeah. Now this, I thought this D part, the company has unexpired credit, tax credit on account of brought forward losses. So this is actually a better disclosure method, friends. So because this is as per the standard which says that you have to, Ind AS 12, which says that you have to disclose how much brought forward losses are there, which is available, how much is the amount you expect by way of set off whenever you set off these losses, and up to which year it is available. So you have to write that also when it is getting expired. So this table I thought is a better presentation, and that's why I thought let me cover it here. So it takes care of disclosure as per Ind AS 12, friends. So you can use it, right? now this is why I have taken this investment property, because it is very good disclosures which is required as per Ind AS 40. So I have given this, so you can take it that how you can disclose as per Ind AS 40, very good disclosure, friends. So that's why I have given this disclosure here. So you can take from here. Exceptional items. Yes, this year you will find in many balance sheets this item has cropped up, and so that's why I thought so you will find impairment of investment in subsidiaries 116 crores, right? Impairment of loans 155 crores, impairment of other loans. So you will find huge impairment coming up during the year. And again they have also tried to sell off certain properties, so they have treated as an exceptional item. So net impact is actually 128 crores compared to last year it was 410 crores. So you see, it throws light that the company is into a very big trouble unless they come out with this. And yeah, 54, 55, these are the notes which the auditor has referred in material uncertainty to related paragraph and EOM paragraph. So there again, management have committed that we are trying to come out of this sluggish phase by taking certain steps. So that's why auditor has said if those steps fail, then there will be a big doubt that whether the company is a going concern or not. And that's why I thought, let me highlight these notes also. So friends, overall, this was my presentation. Hope I have tried to bring out the insights which the companies are taking, how these two very important sectors are badly affected by this pandemic. And that's why I thought, let me take up this example. So thanks again, everybody, so to give me a patient hearing. And Manojji, thanks for inviting me. It was a pleasure sharing my thoughts to you.
Very good insights, Rajesh Bhai.